Coming up today, Nvidia smashes earnings again. I'll take you inside the numbers and the market's live reaction after hours, along with the impact it could have on the entire market. More weakness in retail, the latest from the Fed, and the potential bird flu outbreak. Hey, what's up guys? Welcome back to the Daily Market Review. My name's Jared, and every day after market close I create these videos delivering you a curation of all the latest financial news, data and charts, and putting it all into context for you in an easy to understand format. So if you're an active trader, stock investor, or just interested in financial markets, then go ahead and hit that subscribe button if you haven't already. And these videos will show up in your feed every day, and you can leave it to me to keep you informed on what's really happening across financial markets. I subscribe to over a dozen premium news, data, and institutional research to give you highlights of what I think is the most important market-moving news and data out there that we can all use to make better financial decisions and find the best trades and investments. And thanks to all my regulars for hitting that like button and helping this channel achieve record growth this month. I really do appreciate all your support. All right, let's get right into it today. First off, just touching on the S&P 500, pretty much consolidating here at all-time highs, just above 5,300. And just looking at market color, we do have a little bit of a pullback up the front in some risk on assets, consumer discretionary, industrials, financials, bit of a pullback in utilities along with high yield bonds. Also, we got a little bit of a pop up in volatility in yields today, all of which I'll get into later. First, let's talk about the elephant in the room. And that's the granddaddy of AI, Nvidia, who make graphic processing units, GPUs, and the strong get stronger. And I almost nailed it on my guess yesterday. I thought they'd beat by about 10%, deliver $6.20 in earnings. I was a little bit off. They beat by 9.3%, reported $6.12 a share in earnings versus the estimate of $5.60, also beaten on the top line as well by 5.9%. Stock was pretty much flat in regular session, just closing at $9.49, and just going down to a 5-minute chart post-market as I speak. Currently up a bit over 6%, trading above $1,000 a share for the first time ever. And so it just looked like a layup again, in a similar pattern to Q3 and Q4 last year. Stock gapped up after earnings, consolidated for a few months, and then broke out to start the year. And then we just stalled out on that big bearish engulfing candle in early March, did a bit of a consolidation and pullback, and here we are trading above $1,000 a share. Could be another clean breakout. Technically, what we'll be looking is for a close above $1,000 a share in tomorrow's regular session as a way to kind of confirm that breakout. Then, like I said, if we trade above $1,200 a share, Nvidia will be the largest company in the world, surpassing Apple and Microsoft, the only two stocks in front of it now. And they didn't just beat on earnings and revenue, Wall Street estimates, they also juiced up the stock market algos by announcing a 10-for-1 stock split, along with boosting its dividend. However, what companies like this do is they pay a small dividend, then they're included in dividend index funds, dividend growth funds, things like that. And they also announce stock splits, which are historically good for the stock price, because what it does is it'll take the price of Nvidia shares from $1,000 each to about $100 each. That way, a lot more smaller investors can buy it, and they can also trade the options with lower strike prices. So it improves liquidity in the stock, the options, and historically, that has resulted in better stock price performance overall. And the numbers are just out of this park. They reported a 262% surge in year-over-year revenues, driven mainly by their flagship product, the H100 GPU chip. Data center revenue up 427% from a year ago. Absolutely blockbuster numbers here. And just visualizing that with a bar chart, you can just see that explosive growth over the last couple of quarters turned into absolute cash cow. And we can see that with their gross profit margins. Also out of this world. For a company of this size, 78% gross product margin. In other words, they're pretty much a money printer, head and shoulders above the industry when it comes to their product, and that's likely to remain that way for at least a couple of years. We've already got next generation Blackwell chips on the way, and Jensen Huang hinted he's also got something up his sleeve for after that. So he's moving at the speed of light, and the rest of the market simply cannot catch him anytime soon. And these numbers just go to show this is not a passing fad. AI boom is real, it's got staying power. There's a big change in our world and economy. Biggest companies in the world gobbling up their GPUs. Can't get enough of them. There's a huge build out in infrastructure. We can see that spilled over into utility stocks, a huge amount of electricity AI users, and this is set to continue for some time. And with the next chips, Blackwell, set to cost more than $30,000. That just gives them these huge profit margins. Companies like Meta and Tesla willing to pay up, get thousands of them. And it's not just Nvidia riding the AI boom. Other companies like Alphabet and Meta moving very fast to incorporate AI across their products. What had been lagging, the market's second biggest stop, Apple, in the AI area, They don't really have their own AI product, most cash-rich company in the world. What they've been more focused on over the last decade, they've sent over $650 billion back to investors in the way of share buybacks, boost the stock price up massively, even though revenue has been declining for the last couple of years. However, now we've got the big short investor Steve Eisman saying Apple is a hidden AI play because its products will be central hubs for AI apps. Well, I guess that's true. Apple's always been the gatekeeper for apps, and with their 30% app developers commission, a lot of people call it the internet tax, no doubt there'll be an indirect beneficiary from the AI with the apps, and they've partnered with Google to get their Gemini chatbot into iPhones. However, others like Meta don't want to keep playing the Apple game, and that's why Zuckerberg's placing a big focus on pushing his Meta Quest VR headsets, so he has the hardware advantage, if that's really where the industry's moving next, beyond smartphones. And there's a look at the Apple daily chart. It's actually surprised me a little bit how it's just run up into the 190s here after they pretty much came in line with expectations of earnings. And like I said, earnings have decreased the last couple of years. Warren Buffett trimmed his stock, but they announced that huge buyback, and that's helped to prop up the stock. However, I think it's a good opportunity for longs to take profit up here, and even potentially for those wanting to hedge in this market. Shorting Apple in the mid 190s could be a good play here with a stop above 200. As I can see in my VWAP indicator, we're already 9% above the 50-day VWAP. Pretty big gap for a massive stock like Apple. And I'll also be looking for a short in the mid 190s, playing it back down to the 50-day VWAP, or potentially the low 180s. And that's a good hedge and offset for a traditional long portfolio, especially with names like Nvidia, in which Apple's got growth nowhere near the same as this company. And so there's no way I'd short Nvidia, not even close. And I still expect it to become the largest company in the world this year, something I've been forecasting since the start of the year. And I'm going to stick with that forecast, as I believe we really won't reach the peak in the AI boom until the biggest AI stock becomes the biggest stock in the world, just like Cisco did in the internet boom in the late 90s. And so it was early last year the AI boom kicked off. We had mega cap tech have a really big bounce back. Really kind of skinny rally last year. The Mag 7 overall market breadth was kind of soft. However, that's picked up a lot this year, and this rally is broadening out, which is a good sign in a bull market. We even got the S&P now on track for the strongest first 100 trading days in an election year ever. Again, that's another good technical sign for the things to come. We've got the VIX on a 12 handle. That's historically supportive of good stock market gains. And looking back over the last 34 years, we're at the top end of the range for year-to-date performance for where we sit now, getting towards the end of May. S&P up about 10%, more than double where we normally are around this time of year. And I'd be surprised if we go below this blue line at any point this year, given it's an election year and just how loose financial conditions are and supportive the Fed and Treasury and federal government are of the stock market, spending like crazy, borrowing like crazy, running up long-term debt for future generations to pay off, all for the benefit of the here and now at the younger people's expense. And it's not just market breadth that's broadening out, it's backed up by fundamentals as well. Over the long term, nothing correlates more with stock prices and the stock market as a whole than earnings, and more specifically, free cash flow. And like I said last year, Nvidia was responsible for about 40% of the S&P 500's earnings growth, and the rest was pretty much the other Magnificent Seven stocks: Apple, Amazon, Alphabet, Meta, and Tesla. However, the trend expected for the rest of this year and going into next year, 25, is the rest of the S&P 500 is going to contribute the largest portion of the overall earnings growth year over year. And so you may have noticed over the last couple of weeks, volume in S&P 500, many stocks and ETFs, pulled back dramatically, very low here. And a lot of people think that is lack of participation in the rally. However, looking back in history, that's not necessarily a bad thing. Low volume, as we're grinding higher, and low volatility means just that. The market's just drifting higher. It doesn't take a whole lot to push it. Typically, the volume comes in on selling days. And so there's been a bit of a lack of participation in this market. No one's really selling it. Shorts as a percentage of market cap is at all-time lows. No one's really shorting this market. And like I said, that's not a bad thing. Just look in the last couple of weeks, we've got a bit of a build-up in institutional and retail capital going into money market funds. You could kind of think of that as dry powder. And maybe after this Nvidia earnings result, get a good gap up tomorrow in the stock and the Qs. It's going to get everyone feeling good. Might take some of that dry powder on the sidelines and just pump it back into the stock market. However, counteracting that, we've just reached a bit of a cycle top in the rolling 5-day corporate buyback estimates. That's the amount of stock companies are buying back. Again, a really supportive fundamental action that help keeps the stock market propped up. That's going to take us down to a cycle low somewhere in late July. And seasonally speaking, we can have a bit of mid-year weakness going into the Northern Hemisphere summer. We can often have a pullback in September, October, then normally we rally into the rest of the year. And the corporate buyback cycle is in line with that as well. So we're probably going to break out to all-time highs on the S&P 500 tomorrow. And I'd say this parabolic rally is set to continue ever since Jay Powell and Janet Yellen got underneath it on the very first day of this month. However, with the pullback in corporate buybacks, we may not have a rip-roaring rally like we did out of the gate for this year. May just continue to be a bit more of a slow grind higher. And just looking at a long-term monthly chart of the VIX, down at 12.3, the lowest since pre-COVID. So there's a good chance we take out the 12 handle, go down to 11, and who knows, we may even go in this similar pattern of 2017. We actually got down to an 8 handle before it eventually bottomed out and spiked up in what's known as Volmageddon, February 2018. Just a couple of months, the VIX went from 9 up to 50, wiped out a lot of traders and hedge funds who had been shorting the heck out of volatility going into that. And there's a look at the S&P 500 in 2017. We could be on a similar path to 2017, given that volatility looks like it's on a similar path. So only had some really shallow pullbacks. We've already had a 6% pullback this year in the S&P 500. Maybe that's the biggest we get. And then pretty much just grinded higher. And when things grind higher for so long, it eventually causes a pile on because everyone gets conditioned to the easy money. Long. People were shorting volatility left, right, and center here. There was new exchange traded products shorting volatility. They blew up as well in this Volmageddon event here. We reached a blow off peak. And even though the market only pulled back about 10%, it was that huge spike in VIX caught a lot of people off guard. And so this could very well happen to this market as well. A parabolic grind into a bit of a melt up, then a volatility pop. But if governments have their way, I'd say that wouldn't happen until after the election, especially if Trump got in, as I think then the Fed would have permission to raise rates. And just to present to you some bullish and bearish research, I always try to remain somewhat neutral, give you guys the data and facts, and see what you agree with. We got Ed Yardeni, said the Dow's set to surge 50% by 2030, as the roaring 20s are alive and well for stocks, and he attributes that to growing earnings, which he said S&P earnings could eventually reach, by the end of the decade, $400 per share, and on a forward PE of 20, that would give the S&P 500 an 8,000 target, which is a bit more than 50% higher than where we are now. Also, interestingly, he said helping to fuel those earnings are tens of millions of baby boomers that are set to spend their nest egg on all kinds of goods and services over the next. On the other side of the coin, we've got Smead Capital saying stocks are going nowhere for the next decade as inflation sticks around and US debt balloons. That's Bill Smead, Chief Investment Officer from Smead. So the stock market will see dismal returns for the next 10 to 15 years. Sees a similar situation to the 1970s, with soaring inflation leading to a lost decade for the stock market. Also pointing to massive fiscal deficits, saying there's only 3 ways to balance the budget. You can cut the budget, raise taxes, or inflate your way out of paying it back in devalued American dollars, which pretty much looks like the path current day leaders are taking this economy and markets on. And even though we've got stock market ripping to all-time highs, big AI boom, record corporate profits, unfortunately, most Americans aren't feeling the love. So much so that the majority of them believe the US is already in a recession, and half of them believe the S&P 500 is down for this year and that unemployment is at a 50-year high. Just shows you the huge disconnect between their perception and their reality. And that's not their fault. They're not all financial markets observers like us watching this stuff every day. They're just regular everyday people, and I'd say why they feel like that is they're extrapolating their own situation out to the broader economy. And goes to show you, most people are still grappling with high inflation and prices, especially with things like shelter and food. And that's showing up in retail earnings. Been coming in soft, and we got that again today with Target. Missing on estimates, earnings contracting slightly from last year, along with revenue falling 3%. Same store sales falling 3.7%, and the market did not like that at all. Sold them off 8% today, even though there was a little bit of a buy the dip off the open. What has been a theme of this earnings season is the market punishing stocks that even slightly miss on their numbers. That spilled over to the retail sector, one of the worst performing sectors today, and over the last 2 weeks as well, having a sharp pullback after popping up there. And consumer discretionary sector, not looking that good either. We also got a look at the minutes from the Fed's last meeting, and even though Jay Powell pretty much said they're not going to hike next, they don't want to hike, he wants to cut, some other Fed officials are speaking more towards the numbers in the environment that we're in, and even mention a willingness to tighten policy further should risks to inflation materialize in a way that such an action became appropriate. Highly doubt it they will hike rates. Jay Powell really doesn't want to hike rates. He knows the US government needs rates lower to pay back all their debt, prevent a spiral in the US bond market, also help Biden's chances of re-election. And in addition to coming together in agreement to where the overnight cash rate should be, they also are not in lockstep with their balance sheet runoff. Jay Powell came out in the last meeting and said instead of reducing the Fed's balance sheet by about $100 billion a month, which they had been doing, they've got to cut that in half. In other words, boost liquidity into the system, in which apparently a few Fed officials did not agree with, understandably, because we're still in a structurally higher inflation environment. Risk assets are sitting at all-time highs, and somehow Jay Powell can still come out with a straight face and say financial conditions and monetary policy are restrictive. Even though we've got investment grade and junk bond, corporate spreads above treasuries, the tightest since 2021. Very low on investment grade, less than 1%. It's basically the risk premium investors are asking for bonds on top of treasuries, showing the bond market is not worried at all about corporate defaults. Conditions are loose, risk appetite is high, and we can see that in the price sales, the S&P 500. Above that from the late 90s, the tech bubble, now approaching 3. And like I said, Jay Powell still thinks monetary policy is restrictive and markets require stimulating right here. However, just keep in mind, Jay Powell and all his team pretty much looking at all the same stuff we're looking at, all trying to forecast like we're doing, and like all of us, do not get it right all the time. And just for a bit of deja vu, look at this release from March 2007. The then Fed chairman, Ben Bernanke, told Congress he doesn't believe the economy will slip into a recession and disagreed with Alan Greenspan that the economic expansion could be running out of steam. Things like we see now with Larry Summers and other ex-policymakers coming out, being more able to freely speak their mind. And here's the deja vu part. Last week, the Fed again held a key interest rate steady at 5.25%. That's where we are now, which hasn't budged since August. Pretty much same deal as now. We haven't had a movement since July last year. But the Fed also said there was a possibility that rates could go down or up. Previous policy statements had spoken only of the possibility of rate increases. Wall Street rallied last week on the new language, interpreting it as suggesting the possibility of a rate cut. So that was March 2007, and there's the S&P 500 from March 2007. Had been in a multi-year rally, again another similar setup to now. And we pretty much rallied going into the rest of 2007 before it started to plateau. Then 2008, it really rolled over and we had that big 55% pullback in global stock markets. Also getting it wrong again was Ben Bernanke, who came out, pretty much authored that huge quantitative easing program, massive run up in the Fed's balance sheet, and said back then, this is just a temporary measure till we get things back on track, stabilize markets, then we'll run down the balance sheet. This is not going to be a permanent thing. Well, it turns out he was wrong again. They kept expanding the balance sheet, keeping rates rock bottom lows, even though stock market ran up to new all-time highs, along with unemployment going back down to lows. Took the Fed's balance sheet up to a bit over 4 trillion 2019. Then we had that pretty much what looks like a blip in the markets now. That was COVID. Then they took their balance sheet up from 4 trillion to 9 trillion. And then all of a sudden was surprised. Inflation came out of nowhere due to supply chain disruptions, as they called them. And they've only pulled back their balance sheet a little bit to a bit over 7 trillion. Still well above where we were in 2019. That, along with record federal government spending, has caused this huge bubble, boom, inflation that benefits mostly the top 1% at the expense of the bottom 80%. However, you won't ever hear Jay Powell or Ben Bernanke contribute their actions to this everything bubble and everything inflation that we're all paying every day. So I'm with Goldman Sachs on this. I think the Fed is unlikely to cut rates this year as much as they'd like to. As much as Biden has hinted to Jay Powell he'd like to see a cut before November, with the price action in commodities and the official reported CPI numbers still on a 3 handle. The only way I can see them cutting is if they actually come out and make it official their new inflation target's 3%, which I think they may have already unofficially done. Jay Powell's already kind of hinted at that. They may move the goalposts from 2% to 3%, and then they can just go ahead and start cutting. Then we know for sure they're really just going to devalue the dollar and try and inflate their way out of this debt at the expense of inflation and the dollar's long-term value. And maybe why after these minutes we got yields tracking back up again in defiance of what Powell and Yellen wanted them to do. As we can see here on the 1st of May, when they came out, they successfully talked down yields, getting the 2-year from 503 all the way down to 470. Decent pullback, over 30 basis points in a few weeks. However, it's found support and it's tracking back up to 490. A little bit more sluggish for the 10-year. However, it's going to be very interesting if the bond market goes in defiance of the Fed and the Treasury and pushes yields back up. Might force them to come out with something else and try and get bond yields down. If not, we'll need a genuine spike in unemployment with a real recession to get inflation and yields down. What is working for the government is oil falling. Now putting in a 3-day losing streak, US supply is back to being flush. And we just heard from the Biden administration yesterday, they're going to release over 1 million barrels of gas going into the 4th of July driving weekend, taking a bit of a gamble on their strategic reserves in order to get people feeling good. And just moving on, we could be in the midst of a little bit of an outbreak in bird flu. So we're getting some cases confirmed in America and Australia. Still very early days if it is something. Only a couple of confirmed cases. However, it's enough to get some movement in vaccine stocks with Moderna and Pfizer. Already talking with the federal government to to create a vaccine. And there's a look at Pfizer, up 3.6% today. And doing even better is my long-term favorite, Moderna, up 13.6% today on absolute textbook price action moves. Momentum volume bursts, low volume, low range pullbacks into another burst, etc. and etc. So even though the risk is really low for an outbreak and another pandemic, looks like the market is hedging its bets here. As looking back in 2020, Moderna was one of the best places to be. Ripped up right from the start. There's February 2020, it was trading at $20 a share before the end of the year. Almost did a 10x up to 180. There's a look at the economic data we got out today. Inflation data from the United Kingdom coming in a little hotter than expected. Existing home sales in the States contracting 1.9% month over month. Crude oil inventories going up more than expected, adding to the fall in crude today. And looking out to tomorrow, we've got some PMIs coming across the Eurozone and from the States as well, which are of moderate importance to markets. Fed Fund futures slightly pulling back the chances the Fed will cut in September. Still giving it about 60% odds though, and actually pushing back the second cut to January on the back of those Fed minutes, showing some officials not really in agreeing with Jay Powell and what he's wanting to do. Market's still feeling good with the Fear and Greed Index at 59, and corporate insiders doing a little bit more selling versus buying than usual. There's a look at the Nasdaq Qs, currently trading up 0.39% after hours as I speak. Bit of a pullback in small caps today. The losing index down 0.84% and a continued pullback in short-term breadth, 63% of stocks above the 20-day average. But new highs versus new lows, still in positive territory. VIX just having a slight bump there, up to 12.3. Also got a big crush and bond market volatility, the MOVE index down at 82, along with oil volatility sitting relatively low as well. Markets are pretty calm here. High yield bonds still consolidating, along with the dollar index. A little bit of a pullback for Bitcoin. Still say it's highly likely we hit new all-time highs in the near future. Gold having a little bit of a pullback, along with copper having a bit of a sharp dip today after we've had this parabolic run up. Say this market might be a little crowded here. Could have a bit of a bigger correction ahead of us. However, we've still got agricultural commodities like wheat finding new highs, orange juice still going on a run, and soybeans looking pretty constructive here on the chart as well. Continued pullback for China. Really constructive price action for clean energy. We may have just put in a bottom here in mid-late April and could be going into that stage 1 accumulation phase after we've been in a 3-year bear market for clean energy. Pretty big moves up today in the solar ETF 10, and another one of my favorites I've shared with you guys, hydrogen, having a really good day, moving sharply off these lows. Bit of a fall there for home builders today, along with energy. This sector looks to be consolidating, and still sneaking higher is aerospace and defense at all-time highs. Really not confirming this bull market is Dow theory. Transport's not breaking out, and a little bit of consolidation in the hot sector of utilities. Continued pullback in cannabis. I'm looking at this zone for a bit of a buy the dip. And just checking on Nvidia, the latest price action looks to be consolidating just above $1,000 a share. Like I said, tomorrow for a clean technical breakout, we'll be looking for that close above $1,000 a share, that big psychological level tomorrow. And we may potentially go on a run towards that $1,200 target and become the largest stock in the world. Up and down for Tesla. Also looking technically good is the other big market leader. Over the last year or so, with Nvidia is Eli Lilly, their GLP-1 weight loss drugs, pretty much sitting at all-time highs here, and the trend looks intact in this stock as well. Getting a bit of a sympathy play in Supermicro Computer, up almost 4% after hours, along with ARM and slight pop-up for AMD as well. There's a look at meme favorites. GameStop pulling back a bit today, AMC having a bit of a bump up, and another really hot small stock at the moment, Humacyte, $900 million biotech on a really strong rip these last couple of months. With further falls for those discretionary retailers like Best Buy, down another 3% today on volume, and a bit more soft price action for these banks, maybe on the back of these bond yields moving back up. Alright guys, there we have it for today. Market's been consolidating along with Nvidia. Nvidia's broken out. Say the market's going to break out tomorrow. We'll just be looking to see whether it can hold that going into the close. Otherwise, it's got everything going for it. Low volatility, crude pulling back. Even though yields are bumped up, they're still yet to break out to new highs, and it just looks like the overall momentum in this market is holding here. Let's see how we finish tomorrow, and I look forward to making you another video breaking it all down for you again. Thanks very much for tuning in and hitting that like button, and I'll see you again tomorrow. Cheers.